and welcome to Business Arena on TVP World. I'm your host, Marie Caso. Join me for the main business headlines of the day. A new survey reveals that more than 1/3 of Poles have experienced attempts to steal their personal data over the phone, highlighting growing concerns about cybercrime and identity theft. Fraudsters often impersonate bank employees, government officials, or representatives of well-known companies to trick victims into revealing sensitive data. The National Registry of Debts report underscores that phone-based scams remain one of the most common methods of identity theft in Poland. Experts warn that scammers frequently use sophisticated techniques, including spoofed phone numbers and scripted dialogues, to make their schemes appear credible. Authorities urge the public to stay vigilant, avoiding sharing sensitive information over the phone, and verify the identity of callers before acting. After a rocky 2024 with lower than expected GDP growth and stubborn inflation, the outlook for 2025 looks better, but geopolitical risk and trade uncertainty continue to cloud forecasts.
The third quarter of 2024 in Central and Eastern Europe was marked by weaker than expected GDP growth, leading to downward revisions in 2024 and 2025 forecasts. Erste Group's projections for year-end see Serbia and Croatia taking the lead in growth, followed by Poland at just 2.8%. Hungary and Romania will be this year's worst performers, growing below 1% in 2024. In 2025, Serbia will retain its lead, but will be followed by Poland at 3.3%. Hungary and Romania will recover, albeit below potential. Nevertheless, risks still loom large. Geopolitical tensions, particularly the ongoing Russia-Ukraine war, and uncertainty surrounding U.S. trade and NATO policies under the Trump administration threaten to dampen confidence. Most importantly, a continued crisis in Germany could ripple through the CEE's export-reliant economies. Most exposed to the German risk and Trump trade are the Czech Republic, Hungary, and Slovakia, but Poland is certainly not immune. The least exposed are the Baltics and the Balkans. One of the most concerning developments in the CEE in 2024 was a drop in investments across the board. These investments, of course, included disbursements of EU Recovery and Resilience Facility funds, which countries in the CEE have done a very bad job at taking up. By December 2024, less than a third of RRF allotments to CEE states had been allocated. In 2024, Poland was only able to take up 19% of its allotment. Hungary managed only 9%. Only Slovakia and Estonia managed to take up more than 50%. Now, forecasts for 2025 assume that countries in the CEE will do better in taking up these funds. But this may be difficult for some, including Hungary, where tensions between the Orban government and Brussels remain high. In terms of inflation, while most of the world has managed to get prices under control, the CEE is still struggling. Next year, inflation is expected to ease in Croatia, Romania, and Serbia. In the Czech Republic, Hungary, and Poland, inflation should remain contained, but still high above target. Slovakia, however, due to higher indirect taxes and energy prices, could see inflation double to above 4% in 2025. So, monetary easing is still expected in 2025, albeit with more caution than was forecast in Q3. Finally, fiscal challenges also persist as public spending rises ahead of elections, coupled with higher defense budgets and interest costs. Many CEE nations are grappling with wide fiscal deficits projected to average 4.7% of GDP in 2025, complicating debt management. So, while CEE's economic fundamentals remain positive, persistent geopolitical and fiscal uncertainties mean that many things could still go wrong in 2025.
It's Christmastide, and a lot of us are struggling with indigestion and overeating. But in the world of economics and business, we're thinking about what the future holds for the coming year. Join us today as we look at what 2025 holds for the economies of Central and Eastern Europe. Stay tuned for the bottom line coming up right after the news. Russian gas deliveries via Ukraine are set to come to a halt starting January 1st after Ukraine's refusal to extend the gas transit agreement. While the Russian energy will continue to flow to Europe via a different route, these will only be marginal volumes.
The long-feared shutdown of the main export route for Russian gas to Europe is imminent. However, unlike in previous years, the markets are better prepared to handle the fallout.
There won't be a huge gas supply crisis as it was in 2022 and in 2023. Approximately around 5% of total annual EU import comes via Ukraine from Russia.
So far, markets have shared this confidence, with future prices of natural gas standing at €46 per megawatt hour, some 7 times lower than during the 2022 peak.
So basically, it won't affect EU as a continent. It basically will affect only a few countries.
Some landlocked countries, including Austria and Slovakia, which are solely reliant on the Brotherhood pipeline deliveries, in theory will lose their only route of supply. However, there are options, even for Hungary, who doubled down on Russian gas.
For example, they have an opportunity to import LNG via Croatia. So Austria can do that from Germany, Slovakia can do it via Poland. So there are many options.
Our assessment revealed that there is enough non-Russian available capacity to replace all Russian gas supply in the region. It would create shocks, it would probably increase prices, but physically it is possible.
Russian gas will, however, continue to flow to the EU, with a few countries, including Hungary, still receiving the commodity via Turkstream, the only pipeline set to remain online next year. But its limited capacity will not allow Russia to maintain the same export volume.
With cash may be cooling, but not everyone is ready to let go. The European Central Bank's latest survey shows a drop in banknote and coin transactions down to 52%. Yet many countries in the southern part of the Eurozone remain firmly attached to physical currency.
The era of physical currency might be winding down, even if half of euro area payments remain in notes and coins. In that same span, cash usage has dropped by roughly 20 percentage points, while card payments have gained by an equivalent margin. Notably, the ECB also points to surging mobile transactions, which doubled from 3 to 6% of all in-store payments since 2022. The ECB's country-by-country analysis supports a common stereotype. Southern European nations display a strong preference for physical currency, whereas the North is more inclined towards digital methods. In Slovenia, Austria and Italy, roughly 2/3 of in-store payments are in cash. Malta stands out in particular, where a full 67% of transactions rely on banknotes and coins, the highest in the euro area. In contrast, the Netherlands record only 22% of transactions in cash, making it the most cash-free member of the Eurozone. Finland and Luxembourg also register low reliance on physical money. Now, does age or education affect how Europeans pay? The ECB's findings suggest it does. Individuals over 65 are the most likely to use cash, with around 57% of their point-of-sale transactions settled with notes and coins. Moreover, the higher one's education, the less likely they are to favor cash. Nearly 2/3 of those with only primary schooling prefer cash, compared to a rate of 10 percentage points lower among college graduates. Despite an overall decline, cash remains a powerful mainstay in parts of the euro area, especially in southern nations, among older or less formally educated populations.
And that's all for our business news updates today. For more business stories, check out tvpworld.com.